In this module, we're going to turn our attention to merchandising activities. In our previous modules, we talked about a company that only had service revenues, so no costs of merchandise to deal with. And remember, we are now through the accounting process, so we're going to keep building on that process and adding more depth to it. The first part that we're going to do is by adding merchandise that we have for sale. So this is, you walk into a store, you see the goods for sale, you buy them. The merchant had to pay something for them, so there are accounting transactions related to that. Reporting income for a merchandiser will have net sales, the cost or what the merchant sold it to us, less any discounts, and we'll talk about that later. We'll have a cost of goods sold. What did the merchant have to pay for those goods? So net sales minus cost of goods sold equals what we'll call gross profit. And that's the profit available to cover all of the other expenses. After we pay for the goods, and sell them, what do we have left to cover our salaries, our utilities, our taxes, etc.? Gross profit minus those expenses equals our net income. So we're sort of building on that earlier revenues minus expenses equal net income. Merchandise inventory will show up on our balance sheet as a current asset. We will have goods available for sale. This will show up on our income statement, and we will have costs of goods sold, which will include the cost to buy the merchandise, the cost to ship the merchandise, and the cost to store the merchandise. Do we have any additional costs that we will incur to get the merchandise ready for sale? The operating cycle of a merchandiser looks like this. The cycle moves from we spend some cash to buy some merchandise. In this case, we're buying some bicycles. That becomes our merchandise inventory. We paid cash for the bikes. We have the bikes out on our floor ready to sell. The customer comes in and purchases a bike, either for cash or with accounts receivable. If purchased on account, then we have the accounts receivable. Eventually, the customer pays us and we have the cash collection. We try to keep our operating cycle short because assets tied up in inventory and receivables are not productive. We don't have that cash available for other uses. Let's take a look at what this inventory system looks like. Here's a graphic. We have our starting inventory. To that, we add our net purchases. Beginning inventory plus our purchases equals the merchandise that we have available for sale. So what's sitting out on our retail floor? Merchandise available for sale is either sold and becomes a cost of goods sold, or it's not sold and it remains in our inventory available for sale in the next accounting period. There are two kinds of inventory systems. We're only going to concentrate on a perpetual system. A perpetual system updates the accounting records for each purchase and sale of inventory. So after every sale, we update our accounting records. We update the inventory, we update the ledger accounts, etc. A periodic system does not take the inventory out of the inventory account. Instead, at the end of the accounting cycle, the accounting period, we go back, we count up our inventory, and we adjust it to what that balance says it should be. Now, this used to be a little bit more common than it is today, periodic systems. Sometimes it was cumbersome to keep manual records for nuts and bolts and hoses and pipes, etc., things that we had for sale. With accounting systems now very electronic, it's not such a hard thing to do. So most accounting systems will allow us to keep a perpetual inventory system. We will concentrate our efforts on what that kind of inventory system looks like. Let's pause here and I want you to open your workbooks and we're going to walk through exercise 4-1 together. In exercise 4-1, we're asked to complete the calculations where the yellow highlights are. So A is a scenario, B is a scenario, C is a scenario, etc. So remember that sales minus cost of goods sold equals gross profit. Gross profit minus expenses equals net income. To compute cost of goods sold, we have beginning inventory plus purchases minus ending inventory. So let's just get started with the column A. Column A says that we have cost of goods sold of $34,050. Well, if beginning inventory plus purchases equals merchandise available for sale, that would be $46,000, right? And my cost of goods sold is $34,050, then what must my ending inventory be? My ending inventory is going to be this 46,000 minus the 34,050. So we're going to say equals 38,000 plus the 8,000 minus my ending inventory of 34,000, or my cost of goods sold of 34,050 gives me ending inventory of $11,950. Now I also know that my sales minus my cost of goods sold equals my gross profit. So I'll go ahead and say 62,000 minus my cost of goods sold of 34,050 equals a gross profit of 27,950. My net income then is gross profit minus expenses, what it cost me to make that gross profit. Net income is 17,950. In the next scenario, scenario B, we're given our net income and we have our expenses. So if we know what our net income is and we know what our expenses are, we know that gross profit minus expenses equals net income. So net income plus those expenses would equal gross profit. So I'm going to come in and say my net income plus the expenses equals gross profit. Now I know that sales minus cost of goods sold equals gross profit also, so we can double check that and make sure that that is correct, and it is. So you could have actually done that one either way, right? Well, let's see, it's wanting us to enter this as a negative number as well. So I'm going to come in and put this as a minus. Notice how the other ending inventories are negative numbers. I didn't notice that previously. There we go. All right, so here we have 16,000 cost of goods sold, which is my beginning inventory plus purchases minus ending inventory. So I know that my merchandise inventory at the beginning of the year was $17,050, and I had $3,000 at the end of the year. So I know that my merchandise purchases, I had to have 16,000 plus 3,000. I had to have 19,000 of goods available for sale. So if I had 19,000 available for sale and I had 17,050 to start with, my merchandise purchases are going to be 16,000, and I'm going to say minus this negative number, minus the 17,050 is $1,950. So if you check that out, 17,050 plus 1,950 equals 19,000 minus my 3,000 of ending inventory equals 6,000. The next one, kind of asked to do the same. So in this case, in scenario C, we have a net loss. Our expenses exceeded our gross profit. What is my cost of goods sold? If sales minus cost of goods sold equals gross profit, then my cost of goods sold is my sales number minus the gross profit. $42,250. Again, I'm being asked to compute the merchandise purchases, so I know that I had 51,250 available for sale. How much did I purchase? I purchased the 42,250 I'm going to subtract because it's minus a negative, remember, and then minus my beginning inventory. My purchases were $43,750. So check it again, and we've got 51,250 minus 9,000 equals 42,250 of cost of goods sold. In item D, we're missing the cost of goods sold number. We know our gross profit number. We don't know our sales number. We can get cost of goods sold by just doing this math. It's going to be the sum of the merchandise inventory at the beginning of the year plus purchases minus that ending inventory, which is at a negative, shown as a negative. That's why I can use the sum function. So my ending cost of goods sold is $33,400. Well, if my cost of goods sold is $33,400 and my gross profit is $45,600, what must my sales be? My sales are the sales number minus cost of goods sold equals gross profit. So my total sales are going to be the gross profit plus the cost of goods sold, $79,000. Let's go to item E. Item E says we don't have our net income, we don't have our gross profit. We do know our cost of goods sold, however. So if we know our cost of goods sold, I can easily get my gross profit, right? Gross profit is going to be the sales number minus cost of goods sold. Gross profit minus expenses equals net income, so we'll get those easy ones first. So my net income is $12,600. Now, what's my ending inventory? Beginning purchases were $4,560. Purchases were $6,600, and I have $7,000 on hand at the end. So what I had available is $4,560 plus $6,600, and I either sold it, right, or it's in inventory. Well, I sold $7,000 of it. The remainder is in inventory. $4,160 is then in inventory. I'm going to ask you next to pause this video and go to worksheet number 1 and attempt to solve it. Come back and review the video that solves number 1 in your work. I'm going to go through this part a little fast because the video is limited to 15 minutes and we're approaching that. In QS4-2, we're asked to get the total cost of merchandise inventory. We do that by summing all of the costs. The shipping costs are FOB buyer, that means we pay them. And the acquisition costs of getting it ready to go are $400. Those are included in the inventory. Compute the goods available for sale for Kleiner Merchandise Company. We had beginning inventory of $5,000, net purchases of $3,900. Our goods available for sale then are $8,900. To get our cost of goods sold, we take that goods available from up here, we bring it down to this cell, and we subtract ending inventory. Our cost of goods sold then is $7,200. Our sales number, as we're given, is $9,500. We subtract the cost of goods sold from up here, $7,200, to get a gross profit of $2,300. The income statements for Kleiner Merchandising and Krug Service Company are presented. Remember, this was our old. We had revenues minus expenses equals net income. Now we have net sales less cost of goods sold, that's $7,200 from up here, equals gross profit of $2,300. This is a big thing. Users of the financial statements want to know what the gross profit is, what's available after you sell the good that you purchased to cover your operating expenses. Gross profit minus those expenses equals our net income of $850. We'll see you for the next lesson.